I'm Kyle with Fundamentals of Finance, and it is now time for the good part. Today, I will be covering how to select investments in your 401k or whatever retirement plan that you have. So you're looking at your plan lineup or investment options. You see a whole bunch of options, and it looks like Greek to you. Or if you speak Greek, it looks like some other language that you don't understand. Sometimes it's like this with the individual funds listed. Other times, it just says stuff like large cap stock, and you have to dive through the fine print to see what you're actually investing in. Those ones are super annoying. Generally, there'll be two different kinds of options: target date funds and regular funds. Target date funds will be the ones with the years in them, like 2040, 2045, 2050, etc. If you want to avoid all the headaches of ever choosing your investments, just picking the target date fund with the year that corresponds to your estimated retirement date is usually a pretty solid option. Almost all retirement plans offer them, and they automatically adjust their investments to get more conservative over time as you get closer to retirement and don't have as much time to make up big losses in the stock market, similar to how a financial advisor would do it for you. These are not personalized, but for most people, they do the trick. Set it and forget it. If you want to choose your own options, here's how I would suggest going about it. Actually, real quickly, let me first tell you how not to go about it. A lot of people see the past investment returns or star ratings and just pick the funds with the highest ones. Please don't do that. Major rookie mistake. I remember when I started my career, the BRICS, Brazil, Russia, India, China, were all the rage. They had done incredibly well over the past decade, and the BRIC fund in my 401k had by far the highest return. Well, I don't remember what all the other options were. I would be surprised if almost every single one had beaten the BRICS fund since then. There's a reason you don't really see those anymore. My point is that what's been hot over the last 3, 5, 10, or however many years is often not a good indication of what will do well in the future. The star rating, by the way, is just based on 3, 5, and 10-year past returns. It's not Morningstar's opinion of a fund. So please don't just buy based on what has been hot over the last 3, 5, or 10 years. If you need help with your general asset allocation, like how much stocks or bonds, you can use the target date fund that corresponds to your retirement age as a guide. But then you might as well just invest in the target date fund. For a more personalized allocation, you'd have to talk to a financial advisor, but I will offer some perspective on this. It may sound simple, but this is lost on a surprising amount of people, even people I know who understand investments really well. Stocks are riskier than bonds. Stocks have historically and likely will continue to do better than bonds in the long run. Timing the market is hard. So if you've got a really long time until retirement, you're in your 20s, 30s, or 40s, and you don't plan on retiring until your 60s, there's a strong case to be made for being 100% in equities or stocks at all times. A target date may have you at 70, 80, or 90% stocks at that age, but why not 100%? If you look at all rolling 30-year periods from the beginning of 1976 through April 30th, 2022, and compare the Bloomberg US Ag Bond Index with the S&P 500 Stock Index, you'll see that the worst period for stocks was about the same as the best period for bonds. The average return for stocks was 10.96%, and the average return for bonds was 7.47%. Over a long time period, say from when you're 25 until you're 45, giving up that much return, even on a 5 or 10% portion of your portfolio, can cost you years of retirement income. So while I can't give you personalized advice on this channel, if you've got 15 or more years until you plan to retire, I think it makes a lot of sense for most people to be in 100% equities in their retirement accounts. If you're saving up for a down payment on a house in 2 years, that's obviously a different story, but you can't touch a retirement plan without a penalty until you're 59 and a half. So if you're in your 20s and 30s, the extra volatility in the stock market compared to bonds is likely to be well worth it in the form of higher long-term returns. Once you get to within 10 or 15 years of retirement, then the trade-off starts to become a little dicier, and you should think about reducing your equity exposure. And at that point, it may make sense to switch to a target date or work with a financial advisor for a personalized plan. Okay, so you've decided you want to choose your own investments, and you know what your stock to bond allocation is. Now what? Well, it depends on what options you have. But when I build portfolios for my friends and family, I try to make sure they are globally diversified, whether that's using global funds that invest in both US and non-US companies, or a combination of US focused funds and non-US focused funds. Most retirement plans don't have a global option, so you may have to do this yourself. In addition to being globally diversified, I also tend to include a decent amount of small or mid caps, maybe 10 to 20% for someone who's in 100% equity and is decades away from retirement. These are smaller companies which are often more volatile than larger companies you'll find in most stock mutual funds, but have historically offered high long-term return potential. The future isn't guaranteed, but if you have a long time horizon, it's probably good to get some of these in there. So, 2 things. Number 1, globally diversified, and number 2, 10 to 20% of your stock portion in small or mid caps if you have that option, and you probably do. A lot of plans will categorize the investment options by asset class, like stocks or bonds, and sometimes by geography. Honestly, I've seen it 100 different ways. But even if your plan has almost no detail about your investments, as long as you can figure out what they are with a name or a ticker symbol, you can go to this next and final step. Go through your plan lineup, ignore those past return star ratings, and type each fund or ticker into the search bar on Morningstar.com. You should see something like this. If your plan website didn't give you much detail about your investment options, maybe they just split them into stock funds and bond funds, you can find out if they're focused on the US, global, non-US, or emerging markets by looking at that category here. If you only have one option in each area you want to cover, you're done. If you have multiple, a good way to choose between them is to use the analyst rating if there is one. They pop up next to the star rating, and you can see that this fund has one, but it's currently hidden. Well, good news. If you look below, you can see that Morningstar offers a free 14-day trial of their premium version, which will unlock the analyst ratings. Anything rated bronze, silver, or gold is considered to be recommended, with gold obviously being the best. You will also get access to their write-up on each fund to see why it got the rating that it got. Not every fund has a rating, but the big ones generally do, and those are the most common options in 401k plans. In fact, this is the most common international fund in 401k plans, which is why I picked it here. It's rated silver for the R6 share class, by the way. That's the share class most large retirement plans have. More detailed fund analysis is certainly something I plan to dive further into on this channel, but this is a quick way you can find quality funds without actually needing to know how to analyze them yourself or spend hours doing it. So there you have it. We've covered how much to contribute to your retirement plan, some of the key differences between the common options, asset allocation, and a quick way to pick quality investments. Now, all you've got to do is log onto your company's retirement plan website, which is often looped into the section with all your other benefits, and get started. I can't give personalized advice, but this is a big, complicated world. So if there's a concept I didn't cover or that you're still not understanding, please let me know in the comments and I will either respond to you directly or make another video about it. And if you really want to learn how to invest, check out my free webinar below called The 9 Habits of Successful Investors. The link is below in the description. Thank you for watching, and I will see you in the next video.